From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Hello, and welcome to another episode of the Macrocast. I'm your host, Ylan Mui, a managing director here at Penta, and I'm joined today, as always, by our friends at Markets Policy Partners, Brendan Walsh and John Fagan. And today we also have a special guest right here in studio, Zach Moller. He is director of Third Way's economic program. Third Way is a center-left think tank here in Washington, D.C. Thank you, everyone, for joining me today.
Happy to be here.
Great. So today we're going to be talking about the debt ceiling that's really come into focus over the past week. The X date when the government can no longer pay its bills could be coming sooner than we had thought. We want to talk about Congress's plan for dealing with all this and what the markets are making of everything. So we're going to start, Zach, with you. I'm going to go ahead and just put you in the hot seat to help us understand where we are now and what the state of play is. House Republicans have come up with a plan for raising the debt ceiling that, of course, Democrats say is totally toxic. So what are they going to do? What does the landscape look like right now?
Sure. So, this is a very classic Washington, D.C. One party wants one thing, one party wants the other. They're both ready to blame the other side. But of course, this isn't over something, small like a piece of policy or a tax cut or an end of the year deal or even moderately sized like government spending. This is about the full faith and credit of the United States of America, and everyone is staring each other down at this point. So, President Biden and congressional Democrats have said we need to raise the debt ceiling in a clean fashion. That is, no policy riders attached to it. We're not going to gamble with, or we're not going to negotiate over the full faith and credit of the United States. Republicans are like, well, no, we have massive spending problems. We have a huge inflation problem and debt and deficit problems. Like, this is what the debt ceiling is for. It is for taking a hostage, and it is for negotiating over. And so we're at a bit of an impasse right now. But of course, at the same time, so much has been taken off the table. When the president gave his State of the Union, he was kind of openly negotiating with Speaker McCarthy and congressional Republicans in front of the American people, saying, we're not going to touch Medicare, we're not going to touch Social Security. And everyone
Yeah,
exactly. And everyone kind of seemed in agreement on that. And so we've seen things kind of getting taken off the table. But President Biden is still like, well, no, this isn't a negotiation. We can have negotiations over broader fiscal issues, but we're not going to negotiate over the debt limit. And
But didn't former President Trump also say the same thing?
Yeah, I mean, look, this is
which really puts McCarthy in a tough situation because that's all we spend money on.
Right, exactly. Former President Trump had said, "Yeah, we're not touching Social Security and Medicare either." We're at a crossroads. But of course, look, this happens in D.C. all the time. The question is the issue is this time the stakes are just keep getting higher.
Right. So McCarthy is saying that, in order to raise the debt limit, he said that Republicans are willing to raise it, I think, for 1 year, right, into 2024, that their whole host of spending cuts would have to go into effect.
That's right.
And not just spending cuts, but also additional policy concessions, such as repealing parts of the Inflation Reduction Act, right, clawing back unused COVID relief funds, all these sorts of things, which seem totally anathema to Democrats. So as you said, Zach, we seem to be at an impasse just right out of the gate. So John and Brendan, how are markets thinking about this? I mean, if it seems like the blockade is strong, are markets getting worried at all? Is there any sign that markets are taking this seriously?
So when you look at markets broadly, it's hard to say that that this is spilling over into a generalized deterioration of sentiment. So you're not necessarily seeing it weighing on the S&P 500. The S&P 500 is being moved around by earnings and other dynamics this week. And so it's it's, there's always an element, in these of whistling past the graveyard, perhaps. But, you can forgive market participants for saying, we've seen this movie before, right? Every time there's some dramatics and, I don't want to change my entire, investment strategy based on what is a relatively low probability, but, high risk, but low probability risk. And then, essentially it's so that leaves you with a market kind of fingerprint of these concerns really in very specific places. So if you look at, T-bill markets, for instance, you can see that the T-bill curve is weirdly distorted, right? The front end, like 1 month, which is, probably before the X date, comfortably before the X date, 1 month maturity T-bills have had massive demand. And so the yields have fallen. Yeah. And you see kinks further out. You see, elevated yields in the sort of 2, 3, 4 month kind of time frame, maybe 6 months a little bit lower because there's an estimate that probably 6 months gets you past any sort of potential technical default. And so that's kind of nuanced. And there are other dynamics that are at work, obviously, Fed expectations and other things in T-bill yields. So where it's most obvious is credit default swap spreads. So credit default swaps are essentially what, the spreads are what you pay to insure against default. And, you have credit default swaps or CDS on corporate debt, but you also have it on sovereign debt. And when those spreads widen out, that means that its insurance is more costly, and meaning that the risk is deemed higher for default. And we're seeing a very pronounced widening of U.S. Credit default swaps on U.S. Treasuries, on sovereign U.S. debt.
So in normal times, it costs about $1,000 to insure for $1 million in Treasuries. Now it's almost up to $10,000.
Yeah, and so this is, looking back in the past, 2011 is kind of lifted up as the worst, debt ceiling problem that we've ever had. And the credit default swap spread in that instance got up to 80. It's around 106 this morning. So, there's clearly more concern around this episode, for all the reasons that Zach has put on the table.
So here's a question, which we talked a little bit about last week, but, given that now we have more details around what exactly the policy proposals are, is it better for Republicans or for Democrats if the markets really get upset or really get worried or we start seeing that volatility? Is it better for one party or the other, or is it good for both?
I mean, I think both.
Or bad for both.
Or bad for both, well, exactly.
Look, I think it's obviously bad for everybody.
Yeah.
Increased
Good
volatility
point.
it's going to affect normal people in the markets much more than it's going to affect the political class here in Washington, D.C. The problem, as I see it, is I think both Democrats and Republicans think market volatility is better for their political hand. And that sort of situation where both people think, oh, if the Dow drops 1,000 points, that's going to be better for my negotiating position. Well, that's a really scary proposition, because when both sides are kind of rooting for chaos, we're going to end up with a little bit of chaos.
It seems like McCarthy went up to Wall Street to try to make that happen, right?
Right, absolutely. DC does a pretty good job of reacting to big market swings, and the how chill Wall Street has been about this whole thing so far has really been concerning to some people in DC, where we're like, no. This time is a little bit different, because we are now facing the first major test of Speaker McCarthy's office and his ability to get 218, a majority of the House of Representatives. And so he can propose, caps to discretionary spending. He can propose a $1.5 trillion debt limit increase. But the only number in this bill that matters is that 218, that majority. And until he can show that he can get that, we're not going to see much movement in this negotiating process. And I think markets should realize that, paying attention to the political situation here in DC is going to be really important going forward.
So if he passed a bipartisan bill, is his speakership over?
I mean, that is an open question, right? If it depends on how bipartisan. If he passes a bill and he has large support from the Republicans while doing it, that's different than all of the Democrats and a few Republicans, which is a situation that like John Boehner had gotten himself into years ago on some of this spending and debt stuff.
The other deadline too, which is creeping up, is the fact that we just went through tax day. Americans all just filed their taxes, and we're seeing that tax receipts are coming in perhaps lower than expected, which is moving up the expectations for when that X date is, when the U.S. government could potentially default. What is the dynamic there? Why are receipts, John and Brendan, coming in so much lower than expected? And do you think that we could be in a crisis moment sooner than markets realize?
So 2022 was a perfect storm for capital gains losses. Every major thing you could invest in went down. So the Fed started a very aggressive hiking campaign that pushed yields higher. If you own a fixed income product and the yields go up, the price of that product goes down. So even if you just own treasuries, which was what caused this mini banking crisis, the value of your treasury went down. So you book a loss on that. We know that the equity market was down 20%. Credit markets, high yield credit markets were all down. And also crypto. A lot of people were in crypto and that got demolished. So really nobody made any money in 2022. So you didn't pay any capital gains taxes, where in 2021, people paid massive capital gains taxes.
Is there a calendar issue here for DC, Zach, in which if this deadline ends up coming in the middle of the summer, we all know Congress doesn't like to work over the summer. Lawmakers are not necessarily going to be in session, which means they have to plan ahead in order to avoid a potential debt limit catastrophe. Is how much of an issue could the calendar become?
So we had originally thought that this debt limit X date, the date where we actually default and stop paying, bondholders and are unable to fulfill our broader obligations, we thought it was going to be in June or July or August or September. As tax receipts have come in softer, that is shifting towards the front half of that. Are we going to make it to June 15th, for example, June 15th being the next kind of quarterly tax payment date? If we get to June 15th, then we're definitely bought a few more weeks. But if this is a conversation in June or July, Congress was going to be in session anyway to deal with this. This wasn't like if it was a September 1st X date and Congress was supposed to be out for August recess. What will really happen is it'll just kind of rejigger all of the priorities of what Congress wanted to work on. And then, the big problem is Congress doesn't move the quickest unless it absolutely has to. And, we could find ourselves being told, oh, the X date is 4 weeks away. The X date is 2 weeks away. The X date is 6 weeks away. Those sorts of things will really upend and really restart kind of negotiations here, I think.
When the concerns about the debt limit first started to be raised, there was a lot of discussion about potential break glass solutions, discharge petition being among them. Can you explain what that is? And it sounds like, again, just judging by the calendar, that we may already be too late to use some of these break glass provisions.
Sure. So there's some, in case of emergency, break glass options on the debt limit. Some are, actual things that people could do, right? So you mentioned the discharge petition. The discharge petition is a process in the House of Representatives in which a bill that has majority support can find its own way to the floor without needing to deal with the Rules Committee and the Speaker and that sort of political management of the process. But it's a slow process. The bill needs all these signatures. It needs, to be sitting around and be unacted upon for at least a month. Well, if we are almost a month away from the debt limit, like this was a process that needed to be started yesterday to kind of get through and not, fall under its own time constraints. Another, in case of emergency break glass option, would be passing a different sort of debt limit increase, a very, very small increase or a suspension until like the moment that the bill passes, so that the Treasury's extraordinary measures, which are accounting maneuvers to prevent default, could kind of be reset and we could kind of restart the clock. And maybe that would time negotiations closer to the end of the fiscal year, which would allow maybe negotiations to be over discretionary spending or the 1/3 of the budget that's annually determined. That may be another option there. And then, of course, there's the really weird emergency options that the president could kind of take that may or may not be legal.
Are you talking about debt prioritization there?
Debt prioritization is definitely part of it. That is kind of how Republicans want to have this extra option where you could say we're going to pay bondholders first, then we're going to pay Social Security recipients next, and then we're going to pay vets third. And this prioritization could potentially exist, but the Treasury would need a lot of time to set that up, and they kind of view that as not something that they can do overnight. And we would, need to redo a lot of systems and how Treasury makes payments. That's not a quick option. But there's even weirder stuff than that. We could be talking about the $1 trillion platinum coin that people like to throw around, where we could mint a coin, have it free up $1 trillion of space because of seniorage, and deposit it at the Federal Reserve. We could create premium bonds or bonds with above market interest rates that could be sold at above the principal. Or you could enact the 14th Amendment, which says that the full faith and credit of the United States shouldn't be questioned. So, maybe the debt limit is unconstitutional, and President Biden is going to say, no, we're going to keep paying these bills. And he's going to dare Republicans to stop him, or the Supreme Court to stop that. But of course, all of those options are bizarre. All of those options are not going to necessarily make markets feel better. And it's definitely going to create court challenges, other uncertainty. And even with all of that, you're probably going to trigger, a downgrade in credit ratings and other market stress.
John and Brendan, do you guys feel that, it seems like markets are assuming that Congress will figure this out. How do you think they would react to some of those more bizarre maneuvers? And what do you anticipate a potential worst case scenario could look like?
Yeah, just going through the various bizarre maneuvers. Yeah, it's really hard to game it out because it's so unprecedented. Obviously, if the full faith and credit clause invoked and the president dares Congress or the Supreme Court or whatever what would happen in that case? You have to harken back, or platinum coin, some of this stuff. You have to harken back to what happened in 2011 when there was a downgrade. Obviously, it was that's a lower magnitude of impact on the full faith and credit of the United States than a default or technical default would be. But you saw these kind of, upside down dynamics, which is, the dollar rallied and treasuries rallied because the U.S. got downgraded because, it was a risk off and, uncertainty and sentiment curdled in financial markets. And what do people do? They automatically buy safe haven assets, which are still, even after the downgrade, treasuries and the dollar. And so that was a dynamic that, is, I guess, reassuring on some level, but creates this sort of almost contradictory dynamic, which is, if there is some sort of problem in the U.S. and some sort of technical default is triggered, then maybe investors do the same thing. They rush back into treasuries, rush back into the dollar. Because there's nowhere else to go.
We're the best and the last option.
So.
John, when you were at Treasury, did the Treasury ever have to do special stuff in any of these negotiations?
Yeah, well, there were periods of extraordinary measures, but while I was the 4 years I was there, from late 14 to late 18, there were no really really terrifying episodes of debt ceiling. I guess there was maybe one that was a little bit of a closer call. And, just to harken back to that, we heard, from noises from Capitol Hill saying exactly what Zach was saying, which was, for the Democrat side, it would help us if Wall Street were a little more nervous about this. We're a little more worried, and we saw some, chunkier declines in the S&P 500 because of this risk. It would focus the minds of across the negotiating table from us. But as we said before, it's really hard for particularly, like an equity investor, to sit around a investment meeting and say, hey, I really like next week we've got Alphabet, Meta, and Microsoft earnings. I love all those companies, but we can't buy any of them because we're worried about the debt ceiling. Right. It's just like it's just
2 weeks ago, a lot of investors were in town for the IMF World Bank meetings, and every one of them that I met with was like, I have to ignore that. There's no way to invest on that. And in the end, they'll get it done like they always do.
Right. And then, if there is sort of a worst case scenario outcome, the expectation would be, again, looking back at, some kind of analogous risk. You think back to anybody that was in the markets at the time, the failure of TARP, the initial TARP vote that failed.
Yeah.
And in 2000, what was it? Was it 2009? When the initial TARP vote came.
That was 8, yeah.
Well, it was 08, yeah. And the markets absolutely fell to pieces, and Congress went right back and then voted it through.
Sorry.
We were joking before the call and say, I don't know if Congress can take 15 debt limit votes under Speaker McCarthy, but that might be where we have to go. John, I know you're not a constitutional scholar, so I apologize if I'm putting you on the spot here. But do you think that Treasury has the authority to prioritize debt payments?
Boy, that's
John went to Harvard Law, so he has a strong opinion about everything.
I slept through con law class. I didn't sleep through Professor Elizabeth Warren's class, though. Boy, she kept you on your toes. Anyway, now Senator Warren, obviously, but it's what is constitutional? Well, the Supreme Court has the last word on that, and what is constitutional seems to be a moving target these days. So that really is it is not something that the Treasury Department would relish doing. I'm sure that they would never publicize it, but I'm sure that they have behind the scenes done all kinds of homework on this to if absolutely necessary to be able to act swiftly and judiciously. But the reality is there are going to be challenges, and nobody wants to be playing chicken. And certainly an institution like the Treasury, which is understandably very guarded about its and cherishes the stability and the importance of the Treasury markets and the dollar and so forth. You don't want to be messing around with those. So I think it's something that they don't want to have to test that out at all.
And let me just add on to that, John. This situation where you'd be prioritizing payments, you are either paying everything and then violating the debt limit and breaking the law that way, or by actually prioritizing things and saying we're not going to pay this government contractor in this order when it's the next bill up. You're violating another budget law. So you are choosing which way to be a criminal, and it really puts the Biden administration in a bad situation, which is why this needs to get resolved before it gets to that point.
I think there's also maybe in the minds of the markets, and I don't know, maybe in the minds of lawmakers, which may be more complicated and confusing than the minds of the markets, is this idea of if default happens, again, thinking of worst case scenario, is it intentional or is it accidental? Meaning that some of the processes you outlined, Zach, are so complicated and take so much time that even if Congress were to start down that path, the X date may creep up on us because we know it is a moving target and we may not be able to simply make it in time. Do you think that is a real potential risk versus a more intentional default? And then for John and Brendan, how do you think markets would view that versus view an accidental default versus an intentional default?
So we have had an accidental default before. It happened in 1979. There was administrative confusion over when revenue was coming in or not. And, it was resolved very, very quickly. They had already decided that they were raising the debt limit. It cleared a lot of the problems away, but it happened, and we got through it. But that's different than like riding over the cliff like Thelma and Louise. Like that is unprecedented. And if markets say, all right, there is no, or if here in DC, they haven't voted on the bill yet. They don't know where this is going to get resolved. That is really going over the cliff. That is much more of a purposeful default as opposed to like we've done it. We passed the bill. Oh, it just happens to take a weekend to get some things done, and the Treasury balances got low or something like that. That's a little bit different.
John and Brendan, any thoughts on that?
Yeah, I think that intuition is correct. Yeah, those are I guess one of the questions really is, when it comes to the broader perception, it's a little bit wonky, but the question would be, from a credit default swap perspective, what is there any difference in, how does it get triggered?
Right.
But, that's a very contractual issue, particular to the idiosyncrasies of a credit default swap contract. So that would be the big question. But for broad markets, yeah, I think they could laugh off some sort of like little hiccup as long as the process was going to raise the debt limit and expeditiously. But if there's the Thelma and Louise, we wouldn't be spared the crash.
Well, I think this is something that we're going to keep talking about for the weeks and months to come, especially if we end up in a Thelma and Louise situation. I want to take a few minutes, though, to think not just about the debt limit and sort of Congress being back, but also what's going to be on tap for markets and for economic data over the next week or so. Brendan, I think there are a couple of big releases that are coming out, maybe GDP among them.
Yes. So we bet both the United States GDP and European first quarter GDP. So this is the first look at how growth was, and it looks like it's kind of consensus is 2 to 3%. The Bank of Japan has a meeting, and on Friday we get the Fed's preferred measurement of inflation, the PCE price index. Which is very similar to the CPI, but it's weighted a little differently. The housing component is lower, while medical care is higher in PCE.
Yeah, and in first quarter earnings reporting, we've got about like the heart of the order coming up. Really, we've got Alphabet, Amazon, Meta, Microsoft. Apple is one of the only ones that's going to still be pending there the following week. But it's the calendar's littered with household name reports, even beyond those big, those tech giants. Yeah.
And so far, earnings are down about 6.5% from where they were a year ago. But really what matters is what consensus was. And we predict what the earnings are going to be. And the majority of companies have beat, but not so much that it's really driven the market considerably higher. We're kind of a bit in no man's land in terms of equity trading.
Yeah, Tesla was a little bit disappointing this week. We saw that weigh on tech stocks yesterday in general, and Tesla stock was down like 10%. And the other kind of potholes that we're seeing emerging in earnings are the regional banks. The big mega banks did great for the most part, but regional banks are now reporting. And we had Regions Financial this morning, and that's taking a beating. On lower, a miss on earnings and revenue, as well as lower than expected deposits, and we've got some of the others, including First Republic, I believe, next week.
Great. So lots of economic data to pay attention to next week. The heart of the earnings season. Ongoing discussions about the debt limit. It's going to be a busy week next week. And of course, we'll keep talking about all of it here on the Macrocast. Thank you so much for listening. I'm Ylan Mui with Penta. Thank you to John and Brendan from Markets Policy Partners for joining me. And thank you, of course, to Zach Moller from Third Way for being here as well. Please remember to like and subscribe wherever you listen to your podcast. Have a great day, everybody.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.